Thanks, Stephen. I think what would make sense would be if we just want to give a general overview of Colorado and maybe how you perceive it to be in relation to some of the other states that you guys service and invest in, respectively, and we'll start there.
Boy, Colorado's a pretty boring state. You know, a 3-year redemptive period with a 15-year statutory limitation. Property taxes here are incredibly reasonable, well under 3% of the property. The assessor's assessment is incredibly reasonable. The use of taxes is very reasonable. To give you a comparison, we just did a pool in Illinois, Cook County, and I'm looking at the tax list, and there's 57 things taxing a parcel. Whereas my house in Colorado, there's 6 things taxing it. It's that bridge, those lights, that library. And so, again, a very common sense application of taxes here in Colorado. 64 counties, great disparity between the counties, between Denver to Weld County, which is I think the mobile home capital of Colorado. It's about 15,000 mobile units out there. We got the interview throughout the years about 27 of our treasurers. And they all proved, it's a consistent message that they're stewards of the community and the tax basis, and they take their responsibility in stride. And it's a pleasure doing business here. Ironically, we're based here, and we have a great familiarity with the rule of law. We've bought very few tax liens in Colorado, just hundreds in a couple counties. And that's primarily because the yield right now is tied to the feds, 9 points over the Fed rate on September 17th or something, whatever that is. And so it's been 10% for the last 5 or 6 years. And we're finding people at the auction are bidding into that premium. It's the only state that won't refund your premium as well. So you bid 9 months into your premium, that if it redeems within that 8 or 9 months, you'll have an erosion of principal. You'll lose money. And some of those, so anyway, very difficult state to invest in. You need to have very inexpensive money and be willing to risk paying a premium in a state that has a historically high redemptive rate. And so, I don't know, we've only bought hundreds of liens in Colorado, and it's our backyard.
Yeah. I have nothing to add. Maybe you could just reread that short bio of mine.
So could you talk to us a little bit about the actual auction process and how the premium works and why that would erode capital? Because you are underwater for a decent period of time, depending on how high you go.
Sure. Yeah. All the auctions we've been to here have been live, so they're paddle bids, very old-fashioned, old school, a couple hundred people in a room. Out of our 64 counties, one county, I think it's Arapahoe, has the reputation of throwing junk in there. Of those, all those other treasurers said, if we sell you a garbage lien, come talk to me, I'll fix it. And so that's that sense of stewardship as well there. But here you just, depending on the size of the auction, you'll just, you automatically get a 10% interest rate. That's fixed, but you'll bid in increments of somewhere between 5, I think it goes 5, 10, 15, 20. Then you'll go 40, 80, 100, 200, 300, 400, 500, 1,000. So if you get a guy that's starstruck in the audience, he could accidentally pay a big premium. It does go pretty fast because every 3 increments of whatever the unit is, then they move the decimal place. And so in general, it's a fast-paced auction. They only one auction a year. But it's, Tom, this is the most boring state possible. So you just, we should compare it against other states to make it more interesting. Right?
Well, so that's what I was just going to say next is, so there are other premium states that work similarly, but it's a refundable premium, or you earn the interest rate on the premium, or there's a penalty attached to it. They try to help you out somehow. And so how would this differ from, I mean, you guys are in Alabama, right? In South Carolina. How would it differ from some of those premium states?
And again, a non-refundable premium in a 10% APR environment is extremely dangerous. Just imagine bidding 3 months of your premium or 3 points into it. Eric, El Paso County, what they bid, 5.6% premium. So it was going to take you well over 6 months before you bust even. Okay, so Baltimore, for instance, and Indiana, the premium bid you do earn 10% APR, and so you'll have guys in the auction placing money. We looked at an apartment complex, probably worth about $6 million, townhome style apartments, $150,000 lien. It was the last lien of the day, funny enough, and the guy in the back hadn't made a bid all day, so they go lot, block, parcel, however they called out the title. The guy in the back says $850,000, and so now that owner has to pay 10 points on 150 and 10% APR on the difference, the 700,000. And so, for instance, in Indiana, if you want to place money and go after the deed, there's room to do that. It doesn't take a competing bid. You could just jump. If somebody really wanted that apartment complex, they could have bid $2 million and probably wound up receiving it. Keep stringing us along here, Tom.
Yeah, you have to be careful with the LTVs for sure. So why would you invest in a state like Colorado then? Because obviously it's an incredibly competitive bidding environment, which is why the premiums are being bid up so high. And obviously there's some people that are willing to assume those risks, and presumably some of these funds are moderately intelligent people. Some of them are not, but some of them are smart like you guys. So how does this make sense to come in and bid institutionally on this?
Well, the assessor's process and the assessor's data in all of the counties in Colorado are pretty good, exceptional. There's some county way down south here by Trinidad when we called up, a non-English speaking person answered the phone. It was the part-time janitor, because it was a really small town for real. But outside of that, joking around, the assessor's data here is pretty impeccable and readily available. A lot of your other states and counties, for various reasons, might block your ability to scrape data or go view it. Here, like Florida, the data is very available. So institutionally, you could look at the parcels, trust the assessor's data, which means you could trust the LTV in your risk assessment, and then behind that you have county officials that stand behind what they say. So, and all of that rolls into a very high redemptive rate and a good rule of law. So you can.
Tom, the other thing I would add to that is that the reason you'd buy tax liens in Colorado is because you don't have access to buying them somewhere else where it's more attractive. If you live in Colorado, I mean, you're unlikely to do due diligence or fly to Indiana, Illinois, South Carolina, Georgia, Maryland, New Jersey. You're pretty unlikely to, as an individual investor, go learn what those auction processes are. The returns may be much greater, but it's unlikely for an individual investor here to be motivated to go learn that somewhere else. They'll go in their own county or a neighboring county, which, maybe is the one thing I can say sitting on this panel is why we launched a fund, so that whether you live here or in Arizona or California or Texas or wherever you live, you can buy a nationwide diversified pool of liens that are specifically targeting those states that have the best rule of law, the greatest yields. And so you're not stuck as an investor wanting to own tax liens just in your own backyard. You can own Indiana, South Carolina, Georgia, Alabama, Florida, New Jersey, from wherever you're at.
Absolutely. And so when you're out there on the road, Brian, speaking to investors about being a part of the fund, whether it's on the debt side that you mentioned before, which I think that's a great creative structure, by the way, or on the equity side, what do they really try to differentiate between, can we allocate a certain amount to this state? Do they make demands as to, we need to do a certain amount in Florida, or we don't want to do a certain amount in New Jersey? Or are they just trusting the manager to do that? How do those conversations go?
Yeah, it's really 100% trusting the manager to do it. They're wanting that professional management for tax liens, and really they're just looking at, as I talked about, they're looking for an asset that's non-correlated to Federal Reserve policy, to rising interest rate environment, to the volatility of the stock market. And so, if you asked, read Barron's. If you read Barron's, you look at, they'll have 15 to 20 of supposedly the smartest equity analysts in the world that will provide commentary, and most of them in June. They did their next 12-month outlook. Most of them expect the stock market to return somewhere between 2 and 6%. And they expect there to be a lot of volatility. So for a lot of investors, if the smartest people who are managing large pools of stocks are expecting 2 to 6% with a lot of volatility, and you give the investors the opportunity to earn 8% with virtually no volatility, you know, they don't really care whether you're getting that in New Jersey or South Carolina or Florida. They're just looking at it saying, why would I take the volatility of the stock market and the risk of loss of principal if I can generate potentially an even better return than forecasted for stocks in something like tax liens, where there's a real asset backing it?
Oh, that makes a tremendous amount of sense. Are there any questions from you guys? Nick, real quick.
When investing in Colorado tax liens, what is the biggest, besides the premium, what is the biggest deterrent when you're looking at the state, doing your due diligence, on the front side that really prohibits your investing or purchasing back in the state? What is the real estate market like here? For myself, being from Connecticut, New York, now Puerto Rico, first time in Colorado, what is that like? What do you see as an investor that you have to be concerned about on the front end with your due diligence that can affect your back end, possibly?
Did you catch all that, Brian?
I did, yeah.
Did you? Yeah.
Austin's Air Force days, his hearing isn't the greatest, and so we often sell him things, and he just nods his head yes, and so he ends up buying things and doesn't know what he bought. I've sold him my car 3 times, but I still get to drive it. What's the biggest deterrent other than the premium for investing in? Is there? I'll start by answering part of that. The real estate market here is really healthy. It's got one of the lowest tax bases in the entire country. Most houses in Colorado are taxed somewhere around 0.7% of the actual fair market value, so well under 1%. And so it's extremely attractive from that standpoint. There really is no downside. I mean, the auctions, again, they're not done electronically, so there's a downside of having to register and participate in an auction. But as far as the real estate market, it's incredibly healthy. You're really, really unlikely to get a deed buying Colorado tax liens. And so, to be competitive, you're probably looking at a 3 or 4% annualized yield and going through the headache of getting that. And so for a lot of people, it's just not worth it.
Isn't Denver County doing everything on auction.com or something like that? That website.
Real auction?
Real auction.
Yeah.
That's it. I think they're doing that now. But I don't know how many other states or counties do where they sell you the subsequent years without any kind of bidding, and I think that would be an advantage as well. Colorado, 10%, but in a property that most likely people are going to redeem because it's a valuable property in Colorado, other than a property down in Alabama or something like that. But that's an advantage, I think, also that I found.
Yeah, there's a lot of states that do sell subsequent liens, or at least give preference on subsequent liens. But that would be obviously a legislative change to do that here. And the trend, I don't know if you guys want to comment on the trend of online auctions. It's been kind of slow to be adopted outside of Florida, and as I'm sure all of you can appreciate, by virtue of the fact that these counties are their own little fiefdoms sometimes, they don't always listen to logic and reason in order to make their decisions. But a lot of these counties are going online. I mean, maybe you guys could speak to that. Do you see Colorado coming all online, partially online? How does it compare to others?
I'm opposed to it. I don't think there's any reason to be. I think some of the counties still like the public outcry on the courthouse steps. It's one auction a year. It's not their full-time job. So especially in your rural areas, I think they're going to keep it grassroots type. When you look at the 64 counties in Colorado, one of the barriers, I think there is the 80-20 rule applying. About 12 of the counties house 80% of the population. Right, so Arapahoe, Douglas County, El Paso, they'll probably be more inclined to going online because they're processing volume, whereas Weld County is probably going to stay live, for a while, especially when you get out into Summit County in those areas. Eagle County and Summit County, those are two unique areas in Colorado. They're, what would you call those, Brian? They're not counties, but they're sub-counties. You know, Eagle County has its own tax basis.
Yeah, the resort areas.
Is resort, yeah. So we have a couple of resort areas like Aspen that kind of pluck that inventory out of the tax lien sale. They function like an HOA, and you'll probably never get a slope-side property from a tax lien sale. That's just fact.
It's like Cherry Hill in New Jersey, right? Segment all of the taxing jurisdictions. Jeff, did you have something before?
What percentage of in your portfolio of REO do you see tax agency on the purchase? It's pretty minimal.
So I'll deal with that from the private equity fund side, and then let Austin deal with it on their side. So we have a company that we work with that is essentially a surety position for us, so that if a lien is not going to redeem and foreclosure is going to be pursued, we'll actually sell that to them. You know, typically there's a formula that we use. It's typically at redemptive plus, and so within the private equity fund there won't be any REO. We let somebody who that's all they do is take distressed properties, rehab, and market them, and we let them do that. We don't want to do that, and I don't want to insure them. I don't want to take title to them. I also don't want the headline news of removing grandma from her house. So within the fund itself that I raise money for to invest in liens, we won't hold any REO.
That's it. And when you look at the, we've done everything from having a handful of a couple $1 million funds to our largest fund, maybe we got up to 68 million in 14 states. You know, so the rule of law varies so greatly. You know, being able to disposition it to an established entity like Brian's referring to is a pleasure. Also, the capital requirements can be intense. You know, we just processed 517 deeds in Indiana, so it was about 2,000 tax liens, 1,500 redeemed, which required no additional capital. Then we had to foreclose on 517. It was nearly $4,000 a lien. So you're talking about a $2.2 million capital call. And I don't think Brian wants $2.2 million in idle cash lying around. So again, being able to disposition it out to a business model that takes care of the capital call and moves it to market is a big relief when you're managing your cash and the processes.
Anyone else? Yeah.
If rates end up rising and theoretically a lot of the cheap institutional money leaves the Colorado market, could you ever see yourself coming back to the state and investing in Colorado and dealing with the premiums? Do you still see the return that you guys have to make as a fund manager? Can you see yourself doing that in the future? And do you want to do that?
Yes and yes. I do believe higher yields give people alternatives that they don't have now. And you know, the offset to that would be if more of them go electronically, that makes it easier. You know, would facilitate more investors coming in, especially from out of the state. And so, but yeah, higher yields I think would likely have a depressing, you know, would depress the amount of premium that people are willing to pay because there'd be better cash alternatives. And so, yeah, Colorado is definitely, everything lines up great for Colorado as a tax lien investor, with the exception of most of the auctions end up bidding premiums to the, you know, to where yields don't make sense. If you were able to get 8.5% yields because of the rule of law in Colorado, I think it'd be a great place to invest.
So if you could change those laws and kind of custom tailor it, you know, change the legislation as we were suggesting, you know, how would you change the laws in Colorado to make it a perfect state for you as an investor, as a servicer and a fund manager? What would you do?
Well, you know, a handful of the counties, El Paso County specifically, they have 4 categories for the tax liens. And one of them is kind of the bread and butter of the taxation. It's liens between I think it's $250 and $2,500 or maybe $5,000. They let you sell those in a round robin, and so you get your 10% interest rate. So that's pretty nice way to register. I would ensure that the county sells 100% pretty much, and they could probably conduct an auction with the push of a button. Right. And have it over relatively fast. So seeing more counties adopt on a wider spectrum, the rotational or round robin would be pretty nice.
Interesting. Yeah. That's really interesting. Brian, is there anything that you would change from a private equity management?
I don't think so, because capital is going to compete, and so at the risk of saying make capital less competitive to make the yields better for investors, I may end up being the guy that gets eliminated as they try to limit capital. And so, I think like anything else, you'll see that the industry go through cycles, and there will be times that Colorado may not be very attractive, and then 2-3 years later it may be one of the more attractive states. And so it's such a low risk state compared to some of the others, is what makes it attractive, and it's also why people are willing to accept lower yields. I mean, you're unlikely to go to Baltimore and be willing to accept the same yield that you would in Colorado, because the amount of risk you're going to take is a lot more.
Sure. That makes sense.
Both personally and economically?
Yes.
You're talking about the driving of the due
Yeah.
diligence? You have to bring your gun collection.
What's that?
You have to bring your gun collection.
There we go. That'll work out.
So do you, or can you speak a little bit about pegging the Colorado interest rate to essentially LIBOR, is really to the Fed funds rate, right? So it's the only state. It's very unique in that it does that. I actually don't know the history of it. I don't know if you do, or how does that affect it, or can you speak at all about kind of that unique factor?
Whatever the I think is it tied to LIBOR?
Fed
Right?
funds.
The Fed, right? Every September, I think it's 20th. It's around my birthday. It's 9 points over that with a 1 point floor. When we got into the industry in 2008, I think 08, 9, and 10, we were able to buy a couple thousand liens, and our overbid premium was less than 2 months. And so we were bidding between 0.62%. We got in at when it was at 13%. And I think in 2014, 13, we seen almost 5.5% premiums being paid, which again, because you can have a loss rate, it actually takes almost 9 months to make that up, just to break even.
Right.
Yeah, pretty scary.
It is scary, yeah, and it's interesting because it's one of the states, or the only state that I know of, that it has a floating rate. It's kind of fascinating.
And with Fed funds having been depressed for so long,
Sure.
as if rates normalize faster than people expect, which as an investment advisor is not something that I would expect. I think the Fed's going to go very, very slow when they rise, but at the point in time when it's normalized, then, again, you could easily be talking again about 12, 13, 14% yields here. At least then you can be paying some level of premium on that and still be likely to make 6, 8, 9%. It's just hard. Until the Fed normalizes rates, it's going to be a tough place to invest.
Absolutely. Any final questions for these guys? Yes.
Yeah, do you guys, when you run your funds, do you try to geographically diversify as well in terms of different states, or do you just care about the overall yields, or how does that work? Because I would imagine taking some from Florida, counterbalancing some from the West Coast, vice versa, might get you something, but it may not give you the best yield. So what do you guys do?
Yeah. We do geographically diversify, not only for the diversification reasons of being in multiple states, but there's different time frames for those. So we're looking at redemptive curves for each of the auctions that we're participating in, and lining up that anticipated redemptive curve with the ability to provide liquidity within the fund. So we don't, we wouldn't want to go and overinvest in Colorado where you could have a 3-year wait, and be telling people that they can have a liquidity event at 18 months. And so you have to allocate the money in a way not only to maximize the yield, not only to minimize risk in terms of where you are. Like, we don't want the fund to be overweighted in Baltimore, Maryland, where you could end up with too much REO and not enough redemptions. And then it's also the sales calendar. So it's, when are you deploying money? We're not gonna wait a year to deploy money in Colorado, right? So part of the diversification is just following the sales calendar throughout the country, and part of it is looking to maximize yield, and part of it is looking to maximize liquidity.
Yes.
Between the presentation of the panel, I don't know if we ever really drilled down on the relationship or how P Capital and Atrium work together and different roles and how it plays out. Can you go into that a little bit?
Sure. So I've been familiar with the work that Atrium does for quite a while. Actually looked at buying tax liens myself. Not myself, I asked my wife, I said, do some research and buy some in Douglas County, which is the county to the north of us where we live. And, it's a burdensome process. I met Eric Austin and some others that were doing an institutional investing into tax liens for a couple of very high net worth investors. Became intrigued by that because of my background as a registered investment advisor. And so, my specific expertise is running a private equity fund or an investment portfolio. Theirs is on acquiring and servicing tax liens. And so essentially, the way we work together is we allow them to do what they're good at. We do what we're good at, which is go out and raise the money for it, hire the auditors, administrators, and run it as a professional fund. So they really don't want the headaches of doing reporting and dealing with the SEC and the pricing and the administration of running a fund. And without running that fund, you're very limited in how many investors you can work with. And so the establishing of a formal fund just allows us to work with a much greater number of people than they would if they were trying to do something directly with them.
And we'll bring some muscle to the game, I suppose you could say. Take Baltimore County as an example. I think there was 27,000 parcels the last auction. 11,000 of those were in a big sweet spot, where you just would be a no-brainer to purchase. But we also did 3,800 curbsides prior to the auction. And I think we won 1,700 at 3,800. And the yields on those specifically were considerably higher than the arbitrage play with good data. And so, probably that's the best element we bring to it, is that we're not afraid to get dirty. And then when we start to get stuck with some assets, instead of being stuck with it, we try to turn it into lemonade and bring it to market through a community solution. Now we have a specific vendor, though, that'll, what do you call that there? Articulate that community solution better than we ever have. They're dedicated all their resources towards doing it. So, yeah, we don't mind getting messy and working hard.
Very good.
Yeah.
Well, thank you very much, gentlemen. We
All
really
right,
appreciate it.